So we've been managing thematic natural resource strategies for well over 20 years at this point. In many ways, the circular economy strategy has the same mega trends, the same drivers, the same secular tailwinds. Where the circular economy strategy is different is that it tends to be more diverse. There's an increased level of diversification across sectors, and in many ways it's having more impact in certain areas, probably best measured by the Sustainable Development Goals. And when you look at the impact of the circular economy as measured by those SDGs, there's quite a lot of diversification across that. Biodiversity being a good example, the circular economy strategy is probably our number one in terms of the impact around reducing biodiversity loss and ultimately improving biodiversity. Yeah, so I've been working within the water space for the past decade. Certainly as it relates to investing in water and the impact of water, there is some overlap with what happens in the circular economy. And that's probably most evident as it relates to the impact around biodiversity. There's two key areas around improving biodiversity. One of those relates to water scarcity and water quality, and the other is around the most efficient use of land, etc. And the circular economy strategy is playing both themes. 2 years in, if I was to pick an area where I've been probably pleasantly surprised around the themes and the performance of the strategy, it's probably the pricing power of many of our companies. We've experienced an inflationary environment over the last couple of years, which we haven't seen in a very long time, and the pricing power across much of the portfolio has been really good, and that inflation protection has been coming through. If I was to pick an area that has been very disappointing, it's been in a similar area. It's around that inflation and the move in yields that's happened. And certainly we have some exposure to utilities within the portfolio, and that has been an area of underperformance through that inflationary environment. So it's been a very uncertain environment from the macro perspective over the past couple of years. Many of the highest quality companies that we can get exposure to happen to be in the US, and they have been attractive on a relative basis over the short to medium term. And the other thing I'd probably highlight is that while we may have a higher weighting in US listed stocks, it is worth pointing out that on a revenue basis, so where our companies are generating their revenue, it looks quite different. We have almost 20% of the portfolio where revenues are generated in emerging markets, whereas our actual weighting to emerging market stocks is significantly lower than that. So over the last couple of years, there's been some big winners and losers, and ultimately our valuation sensitive investment process has us looking for the areas that look most attractive over the next 3 to 5 years. At this point in time, utilities are right up there in terms of an attractive investment proposition. We're investing in utilities across clean energy, across water. These are areas with huge secular drivers, and we believe very good levels of compounding earnings growth into the future. And we think that will be an area of outperformance over the next 2 to 3 years.